Take a look at the headlines, and modern India looks like an unstoppable economic engine. The stock market is setting new records on a regular basis. The country has officially become the world's fifth largest economy, and the national vault is packed with a massive $700 billion in foreign exchange reserves. But sitting right next to those booming statistics is a glaring, persistent problem. The Indian rupee is repeatedly hitting historic lows against the US dollar. The slide is severe enough that analysts are now seriously debating whether we'll see the rupee hit 150 to the dollar in the coming years. To understand why this is happening, we first have to clear up a very popular internet myth. You might have heard that back in 1947, 1 rupee was equal to 1 US dollar. That never happened. At independence, the rupee was tied to the British pound, and a single dollar would have cost you about 3 rupees and 30 paise. The rupee's true struggle with the dollar began slightly earlier at the 1944 Bretton Woods Conference. As World War II ended, the global financial system was rewritten, and the US dollar was crowned the new boss of international trade. To buy oil, machinery, or supplies on the global market, a newly independent India was forced to pay in dollars. The rupee's current slide is part of a 60-year loop. It stems from decades of systemic structural failures, matched with government supplying temporary financial band-aids instead of curing the underlying disease. The first major break in the system happened in the 1960s. India was in a vulnerable position. The country had fought wars with China and Pakistan, a severe drought was ravaging agriculture, and the government was heavily dependent on American aid just to feed the population. Under intense pressure from the US and the IMF, Prime Minister Indira Gandhi made a drastic decision. On June 6, 1966, the government devalued the rupee by 36% overnight. This basic economic scale illustrates the theory behind that decision. When a country weakens its own currency, its goods become cheaper for the rest of the world to buy. As the currency value drops on one side, export volume and foreign capital are supposed to rise on the other. But theory rarely survives reality. Because of the drought, India had virtually no agricultural surplus. There was nothing to actually export. The exports failed to materialize, and foreign imports like machinery and fertilizer became devastatingly expensive overnight. Inflation spiked immediately. The 1966 devaluation set a precedent for choosing short-term currency manipulation over industrial reform. This reliance on fiscal shortcuts left the underlying trade deficit unaddressed, ensuring that India remained dependent on foreign imports for its most basic needs for decades to come. Fast forward 25 years. India had survived the intervening decades largely by taking on more and more foreign debt. Then, in 1990, Saddam Hussein invaded Kuwait. The Gulf War caused global crude oil prices to jump from $15 to $40 a barrel, doubling India's import bill in a matter of days. The math became fatal. India's foreign exchange reserves plummeted to $1.2 billion, enough to cover roughly 3 weeks of essential imports. The nation was weeks away from a total default, with foreign lenders refusing to extend any more credit. With 0 options left, the government initiated a highly secretive operation. Under heavy security, 67 tons of India's gold reserves were loaded onto chartered cargo planes and flown out of the country to banks in London and Switzerland. The gold was handed over as collateral just to secure emergency loans. When the public found out that the country's physical wealth was being pawned off to foreign banks, it was viewed as a deep national humiliation. The sheer trauma of that moment finally broke through the political gridlock, forcing the government to introduce the historic 1991 liberalization reforms and open the economy to the world. Those reforms saved India from defaulting. Foreign companies arrived and markets were liberalized, but the underlying disease went untreated. Opening the borders to trade did not build the domestic factories needed to actually produce physical goods. That failure to manufacture left the rupee entirely exposed to the whims of global events. In 1998, after India conducted nuclear tests in Pokhran, the US slammed the economy with severe sanctions. Then again, in 2013, a mere hint from the US Federal Reserve about raising interest rates caused instant panic. In both cases, the rupee went into freefall. The culprit was something called hot money. These are foreign investments injected into the stock market during good times to chase quick profits. The second there is geopolitical tension, or a better deal back in America, that money is pulled out of India instantly, leaving the currency to collapse. To survive these sudden crashes, governments repeatedly turn to financial gimmicks. Instead of exporting goods to earn genuine revenue, they launched schemes begging non-resident Indians to deposit their dollars into Indian banks, offering them high interest rates just to temporarily inflate the national reserves. The secondary fix was to penalize the public. In times of crisis, the government of Prime Minister Manmohan Singh would plead with citizens to stop buying gold, while the government hiked import tariffs overnight to force demand down. Whether it was 1991, 1998, or 2013, the playbook never changed. The government applied a financial painkiller to survive the immediate week, allowing the structural rot of the economy to persist until the next global shock. The dollar drain stems from a missing industrial bridge between India's raw materials and its final products. While the country holds vast natural reserves, it lacks the infrastructure to process them domestically, forcing a reliance on foreign factories. This flowchart explains what economists call the Diet Coke paradox. India holds some of the largest reserves of bauxite in the world, but the country exports it as raw dirt for a tiny fraction of its potential worth. Other nations take that cheap Indian dirt, refine it into aluminum, and sell it back to India as finished, expensive aluminum cans. India gives away the raw material for pennies and spends heavy dollars buying back the exact same material in its finished form. You see the same flaw in agriculture. India requires millions of tons of fertilizer every year to sustain its farms, yet the country still imports 50% of the natural gas it needs just to manufacture its own fertilizer. When global conflicts spike the price of gas, the cost of growing basic food in India skyrockets. This inescapable trade deficit dictates the fate of the currency. To pay for these massive imports, the Reserve Bank has to constantly sell off rupees to buy dollars. By flooding the market with rupees, the currency's value goes down. It is a mathematical guarantee of decline. Fast forward to the present day. It is true that the Reserve Bank now holds nearly $700 billion in foreign exchange reserves. That buffer means we are not going to default tomorrow, but officials recently admitted that pile of money only provides about 11 months of import cover if foreign capital suddenly stops flowing in. Despite heavy promotion of the Make in India campaign, the addiction hasn't been broken. The country still buys 85% of its crude oil in dollars and balances its trade deficit using volatile stock market investments and remittances from Indians working abroad. Compare that to China. China maintains control over currency specifically because it manufactures the physical goods the entire world relies on. If foreign nations want Chinese electronics or solar panels, they have to participate in the Chinese economy. They produce, therefore they have leverage. Meanwhile, the Indian government's modern response to the falling rupee looks entirely familiar. In 2024, they once again raised the import duty on gold to nearly 18.5%, using the same panicked painkillers they prescribed back in 1991 and 2013. As long as the system only reacts when the fire is already burning, nothing changes, until the country undertakes the grueling work of scaling real domestic manufacturing. The rupee will remain defenseless on its downward path.